Hello everyone, Tom Simmons here, and today's Introduction to Business lesson is focused on the different ways you can organize your business legally. And there are a number of choices that you have, and we're going to look at sole proprietorship, a partnership, a corporation in three different versions: a private corporation, a public corporation, and a nonprofit corporation, as well as an LLC, and which is a limited liability company, and which form you use to organize your business is going to have implications on a whole series of things, such as how easy it is to actually form it, how easy it is to capitalize it, meaning get loans or get funds for your business, where the decision-making authority rests within the organization. There are tax implications for each. There are liability implications for each. And then we'll also look at how easy it is to end the business if you wish to end it or dissolve it. So a lot of different terms, a lot of different possibilities. So let's go through each one at a time. And the first one is a sole proprietorship. The sole proprietorship is the easiest form of business to start. And in fact, 3/4 of the businesses in America are sole proprietorship. That means it's owned by one person or one person and their spouse. It is as easy as saying, let's do this. You make jewelry and you say, I'm going to sell it on eBay or Etsy. You are a business. It is that simple. You just declare it. Now, to be sure, there may be licenses within your town or your state that you have to file for. But to start the business is just as simple as saying, yes, I'm doing it, and you jump into it. The decision-making remains with you. It's your business, so you make the decisions. You don't have to worry about others. Of course, there are strengths and weaknesses with that. When you're the sole decision maker and you're running the business, you can do what you want, which is what a lot of people want to do when they go into business. But it also means you don't have the input of people who have expertise in areas that you may not have. And many businesses will fail because someone thinks they can do it all. They can do the sales, the product development, the customer relationships, the finance. And most people, no matter how good they are not experts in every one of those different areas. But you do have that decision-making capacity yourself. When it comes to capitalization, meaning seeking to get funds to expand your business or grow your business, it is the hardest form to convince a bank or a lender to lend to, because it's considered extremely risky. So there, maybe down the road you may consider changing your form of organization. But the sole proprietorship is going to be a tough one to sell to a bank if you need financing. Now, where the sole proprietorship really is very, very different from some of the other forms of organization is that under the law, you and your business are one. You are a single entity. There is no difference between you and your business. And that means that when it comes time for you to file your individual income tax with the federal government, the profit that your business has made, or the loss, is considered your income. So you end up putting that on your personal income tax. You use what's called the Schedule C, or a Form C, with your individual income tax. And the business's profit or loss is your profit or loss. Now that also has implications for liability. And what I mean is this: if you're in debt with your company, or if someone sues your company and gets a judgment against you for $50,000 or $100,000, you are your company. And that means you can't say, well, my company's only got $3,000 in the bank. The person who wins the judgment or obtains, a debt against you, against your company, can come against you personally and your home and your personal bank accounts and your personal assets, because there is no legal distinction between you and your company. So that if you're involved in a very risky operation, you might want to think that this is not the right form of organization for you, because if something goes wrong, the person can come against you. In terms of dissolving it, it's as simple as it was to start it. You simply decide, I'm closing up shop, I'm not doing this anymore, and your business is over. If you pass away while it's still up and running, and you want to put it in your will, just like anything else that you own, and will it to your spouse or to your child, you can do that. And they can continue it, or they can say, nope, don't want it, and just close it up. So in many ways, it's very easy, it's very simple, it's very quick. A lot of small entrepreneurs start out as sole proprietorships. As I said, 75% of the businesses in America today are sole proprietorships. So it's very common and very easy. Now, moving into one step further of complexity, there is the possibility of having a partnership. In a partnership, you are getting together with one other person, not your spouse, or more. You could have 20 partners, you could have 100 partners, and you get together as a partnership to run this business. Now, it's almost as easy as a sole proprietorship, but there's a lot of paperwork involved in drawing up the agreement between you and your other partners, so that everyone is clear and has an understanding of what their responsibilities and roles are in the company. Banks are not likely, again, to give you a loan. Partnerships are considered risky. In fact, they are the least most common form of organization in the United States. And the ones that are able to get capitalization tend to be very high income businesses, like a partnership of a law firm or a medical practice. They're often partnerships. You do have the strength of the partners being able to all contribute a certain amount of capital to the business, so that's one way to raise more money to get the business launched. And of course, you have the decision-making skills of all of the people who are partners. So maybe if your strength is finance and someone else's is customer service and someone else's is marketing, you bring those skills to the table. It does, of course, mean that you lose the ability to say, I want to do this when I want to do it, because the partners all have something to say about it. And sometimes that works really, really well. And sometimes it doesn't. Sometimes there's a lot of antagonism or disagreement between the partners once things get going. On the subject of taxes, it's treated similar to a sole proprietorship, meaning you are your business. So if the partnership makes $100,000 this year, and there are 5 partners, then $20,000 of income will be assumed to be yours on your individual income tax. And once again, there's some complicated paperwork that has to be filed, because you have to show how much the partnership made and who the partners are and who the money gets distributed to. But the partnership doesn't file its own income tax. It does file forms that will be included with your personal income tax, and then you will pay tax on that. In terms of liability, once again, you are your company. It's just that there's a group of you instead of one. So if someone gets a judgment against your partnership, everyone is liable. And what's dangerous, and this is one of the reasons why there are so few partnerships in the United States, is that if you have 5 partners and someone gets a big judgment against your company, wins a big lawsuit, that doesn't mean that each of you is responsible for 1/5 of the judgment. Every one of you is responsible for the full amount of the judgment. So once again, if someone gets a judgment against your company for $100,000 and there's 5 of you, but 4 of you have absolutely no assets, the one of you who is remaining there, you can be on the hook for all $100,000. It's not, you've really want to be in a situation where you really know and trust your partners when you do this. In terms of dissolving a partnership, partnerships actually dissolve more easily than most people would like. If you have 10 partners in the partnership and one of them says, you know what, I'm done with this, I'm resigning, I don't want to be involved anymore, you no longer have a partnership at all. The 9 of you who are remaining have to draw up a new set of partnership agreements, transfer the assets from the old partnership to the new partnership. So that gets complicated because the partnership is assumed to be the whole group of people. And if one leaves or one passes away, then you've got to go through the whole process all over again. So for a lot of people, that's a reason not to put yourself in the situation of being in a partnership. So the third way of organizing is a corporation. And many people think of a corporation as something big, like ExxonMobil, and all I'm doing is organizing weddings or something like that, so I don't have to be a corporation. Well, corporations can be a single person operation because how the law treats corporations is very different than how they treat individuals. So let's go through that. To become a corporation, you need to start by filing articles of incorporation with your state. And different states may call this something different. It's usually articles of incorporation. They may have a different name. And basically it says that a number of people are giving birth to this new entity. And once the Secretary of State approves the Articles of Incorporation, and you also have to have bylaws, and you have to have a lot of explanation as to what it is you're doing, there's then an election for the directors of the corporation, and they become the ones who run this entity. One of the other things you need to do if you're a corporation is you have to decide who owns it. And just because a director doesn't mean you own it. The corporation has to issue shares of stock, whether it's a one-person corporation or a million-person corporation. Whoever they issue shares of stock to becomes an owner. Now, if you are just a family business, you're a small business, maybe, as I said, an event planner or a wedding organizer, it's very simple, even though it sounds complicated. You file your articles of incorporation, you name yourself as the first director, you issue 100 shares of stock, and all 100 shares of stock go to you, or 50 to you and 50 to your spouse, or whatever you want to do. The people who own the shares of stock are technically the owners of the corporation, and you just make yourself an owner by issuing yourself shares of stock. And then annually you will have to have a shareholders meeting, which might be you and one other person, and you elect yourself to the board of directors and file it with the state, and you move on. The corporation is considered it's not you, it's a separate entity. And that means when banks are looking to make if you're looking to get a loan from a bank, corporations are a lot easier to loan to. Banks are a little more comfortable with a corporate entity. It also means that you are taxed twice, and here's what I mean by that. It's called the double taxation problem. Your corporation is not you. You are separate entities. Therefore, when your corporation makes a profit, your corporation will pay taxes. It will file its own income tax separate from you and pay taxes on it. Then when your corporation pays you as an employee or offers dividends to its owners, its shareholders, they will also pay tax again on the dividends that they've received. There is also, for a corporation, limited liability. And that means if someone sues your corporation and wins a judgment, the amount they're able to collect is limited to the amount of assets you have in the corporation. They can't go after you personally. This is a big positive for incorporating. Why? Because you are not your corporation. Your corporation is an independent entity from you, and that's how the law treats it. Lastly, corporations are meant to go on forever. If you die, if you don't want to be involved anymore, someone pulls out of the business goes on. Why? Once again, it's that legal concept that the corporation is not you. So it doesn't need you to go on. It's meant to last forever. And there are thousands of corporations that are completely inactive. And if you want a corporation, you can actually buy the corporate name and just assume new ownership of it. That, so far, everything I've discussed really applies to that closed corporation where you're a small one-person, two-person entity and you're incorporating. Now, all of that is called a private corporation or a closed corporation because there's not people from the outside involved in what's going on here. If you are a large business, you might want to consider being a public corporation. Most of what I've just said applies the same to a public corporation as a private corporation, with one difference. Instead of issuing shares of stock to yourself and your significant other, instead you sell it on public markets, on the stock market. And that's what people mostly think of when they think of corporations. They think of these big things, these big entities that sell shares of stock all the time. When a company does that, first of all, you've got to have a lot of money behind you, a lot of capitalization. You can't just be doing something out of your garage and end up on the stock exchange. It doesn't work that way. Excuse me. But if you are a large company with a lot of capital, then you can go public. You can sell shares of your company to the public. And when you do that, technically, everyone who owns a share of stock is an owner of the company. Now, why would you do that? You would do that because it brings in a lot of money. If you issue 1 million shares of stock and they're valued at $10 each, you've just brought in $10 million. So often a company will go public when they want to raise a lot of capital for a company expansion. Technically, you lose decision-making control of your company. Now, on a day-to-day situation, it's the staff and the directors of the corporation who will make the decisions. But the owners are the shareholders. So all those people who own shares of stock, they technically own the company. And once a year, there will be a shareholders meeting. And they choose the directors. And they can choose policy decisions. So you do lose that ability to simply make decisions on your own. You are now dealing with a lot of other people. So you have to weigh one against the other. A lot of revenue for expansion, losing control to what the shareholders want. Like a closed corporation, you have limited liability, which means a judgment against the corporation can't come after you or the shareholders. If I own a share of Harley-Davidson stock and someone sues Harley-Davidson for a bad piece in their motorcycles, they can't come after me personally as a shareholder. Limited liability. The corporation will also have to file taxes on its own, which can get very complicated, very costly, and include a team of accountants. And once again, the corporation is meant to go on forever. If directors leave, if directors die, if directors change, nothing changes to the existence of that corporation. So the corporation, runs a wide gamut from just a one-person operation to a multinational operation. There's a type of corporation called a non-profit corporation, which operates along many of the same principles. And a lot of people think, well, I'm going to do a non-profit. Well, understand you're doing a corporation. If you want to do a non-profit corporation, first you have to incorporate as a corporation in a state, just like any other corporation. And while most people will choose their home state to do it, the fact is the majority of corporations, I'm not just talking nonprofits here, all corporations, the majority are incorporated in the state of Delaware. Because you can incorporate in the state where you are or in any state where you do business or have a nexus, a business connection. The state of Delaware has a chancery court, which is an expert court in corporate governance, and the Secretary of State of Delaware has stated that they will act as an agent for anyone who wants to incorporate in Delaware to receive legal notices and things like that. So that creates the connection. So many, if not most, large corporations tend to focus on incorporating in Delaware. So you and your nonprofit, you're probably not going to do that. You're probably going to incorporate in your local state. So you incorporate, you go through the paperwork, pay your fees. Once the state has approved your corporation, you then have to apply to the Internal Revenue Service, the Federal Internal Revenue Service. And you can't just apply because you want to do a nice thing, okay? Maybe you've got this idea, hey, I think it's important for bluebirds to repopulate New England. So I'm going to build birdhouses for sale, and I'm going to call it a nonprofit because it's helping the birds. Well, that doesn't qualify. In order to be a nonprofit, you must meet very specific categories that the Internal Revenue Service has set up. It has to be a religious, charitable, education, scientific, or animal rescue operation. There are very few exceptions outside of those. It's got to be for that specific, one of those specific reasons. If you meet the requirements, and usually the IRS will send you a letter back saying, what about this, asking you various questions about what you intend to do, how you intend to raise money. And they will then approve you. This is a process that often takes about 18 months, historically. So it's not something that happens quickly. Once you've got your nonprofit corporation engaging in whatever charitable activity that you've set it up for, the directors tend to be, they don't issue stock. This is one big difference with a nonprofit corporation. They don't issue stock, they elect directors, and the directors elect their own successor directors. So you do have a lot of control over what you're doing with that nonprofit because you're not answering to shareholders. On the other hand, you have very limited access to capital if you want to expand. And most nonprofits will tell you they spend an awful lot of their time fundraising, seeking donations from people, trying to get money from just the goodwill of others, because they're not going to get huge loans from banks, because banks they're not convinced about that they're going to get paid back. So you've got that capitalization issue, and a lot of nonprofits, and we're going to do a whole lesson on nonprofits at the end of this course. A lot of nonprofits will open a business to try and subsidize or fund their nonprofit operation. And that's fine. But a nonprofit normally does not have to file income tax. They do have to file an annual report called an I-990 about what's come in and what's gone out. But if your nonprofit opens up a business to support the nonprofit, then that business has to file an income tax. So that can get a little complicated. There is limited liability, so the directors are protected from lawsuits against the nonprofit itself. To dissolve the nonprofit, you've got to file articles of dissolution with your state government, and all of the assets must be given to another nonprofit. So you can't just say, let's just sell the building and we'll divide it amongst us. The building has to go to some other nonprofit. The last form of organization is a LLC, a limited liability company. A lot of people erroneously call it a limited liability corporation. It's not a corporation. It's an LLC. C stands for company. This is it's a very popular choice for small businesses. It's also a very complicated choice and is fraught with issues that a lot of people don't consider. An LLC is, how you form it is determined by the rules of every state. And because they are so new, whereas corporations and partnerships and sole proprietorships have histories going back hundreds of years, and legal theories behind them, LLCs do not have that. So every state has made their own rules for what constitutes an LLC. And we're going to get back to why that's important later. But you follow whatever the rules of your state are. It usually involves filing a lot of paperwork. The owners are called members of the LLC, the limited liability company. Decision making is made by those members. There is no stock that has to be issued to anyone. The public doesn't have a say, or shareholders don't have a say in how your company actually runs. Banks are often reluctant to give a loan to an LLC because of the questions of what are these things. You do have limited liability, so that's you have the positive strength of being like a corporation because your liability is limited. But you don't have double taxation. Instead, the profit that the LLC makes is distributed to the members of the LLC, and you're reported on your personal income tax. However, in most states, the member of the LLC is considered an employee, which means they have to, or self-employed, which means they have to file self-employment tax in addition to the regular tax on the income. So it's very complicated. And to dissolve an LLC, the majority of the members must agree to dissolve. You just can't pull out of it. So once you're in, you're kind of in and stuck, unless the majority agree to dissolve it. Now here's the real downfall of an LLC. As I stated earlier, every state is different. And if you begin to sell things across state lines or have any type of business interactions across state lines, and someone sues you from that state, a different state may treat you separately. So for instance, you may be considered an LLC in Massachusetts because you went through the Massachusetts LLC paperwork and approval, But Pennsylvania, if someone's suing you from Pennsylvania, Pennsylvania says, no, you haven't done what we require you to do to be an LLC. And as far as we're concerned, you're a partnership. Well, all of a sudden you had limited liability and now you don't. So it's kind of the Wild West of business organizations. If you know you're only going to be doing operations within a very small area, and it's not likely that you'll ever cross state borders, then an LLC might be more palatable for you. If there's any chance that you're in Massachusetts and you might do business in Vermont or New York or Connecticut or New Hampshire, all of which are pretty close, then it could get problematic if things get ugly. So those are your forms of organization. Sole proprietorship, where you're paying taxes and your liability is unlimited. They can come after you, but it's easy. A partnership, which you have to divide your decision making among your partners. It can become a paperwork nightmare when someone quits or leaves. You also have unlimited liability, and you're filing taxes on your personal income tax. Corporation gives you the safety of being limited from lawsuits personally. You have limited liability, but your corporation now has to pay taxes. There's a lot of paperwork to go through, but it's going to be a lot easier to get a loan from the bank. And then your LLC, which again might work for you. It gives you the corporate benefit of limited liability, but you're not getting taxed twice. It's going on your individual income tax. So there's a lot of things to weigh here. Depends on how risk tolerant or risk averse you are. It depends on the nature of the business, and there are no right or wrong answers as a general rule. It really has to do with your personality and what kind of a risk you're willing to take. Now, I will tell you, if you're trying to run a kids' theme park with carnival rides, I would not be a sole proprietorship, because that's a lawsuit waiting to happen. On the other hand, if you're selling soap at farmers markets, you can probably get away with a sole proprietorship really easy. A lot of businesses are somewhere in between, and you've got to weigh all of these factors. I have uploaded to our class website a comparison of everything I just went through, all the different forms of organizations, all the pluses and all the minuses. It'll probably be a lot easier for you to go through that rather than just listen to me talk on this video over and over. You got any questions? You know how to get a hold of me. All right? Thanks a lot.